$1 million used to be considered the benchmark of wealth for many people. At that point, you'd be considered wealthy. Millionaires live in beautiful homes, drive fancy cars, and are either highly paid executives or successful business owners, right? This may have been true 40, 50, or 60 years ago, but in today's money, $1 million doesn't have the purchasing power that it used to. Most poor people would be surprised to know that just because someone is a millionaire doesn't necessarily mean they're rich or even financially independent. It seems like a lot of money, but how much cash flow does $1 million invested actually produce? Will it provide enough income for retirement? Take a look at what type of lifestyle you could expect with a $1 million nest egg and if it will be as posh as it's often portrayed. My name is Chris, and I help teach people about money, personal finance, and investing. If you're interested in improving your financial future, make sure to subscribe to the channel and hit the like button if this video is helpful. It's easy to take a look at yearly returns of a portfolio and assume it's safe to withdraw those gains for spending during retirement. If $1 million in investments gain 12% or $120,000 in 1 year, you could just withdraw that amount and spend it, right? Then during the next year, the portfolio might return 8%, in which case you'd be receiving $80,000 from that sum. This might work, but the problem is the returns from the stock market vary dramatically from year to year. For example, during 2018, the S&P 500 returned an appalling -6%, meaning you'd have a $60,000 loss. That won't leave much in the way of spending. In 2019, the S&P 500 returned almost 29%, making it a profitable year for investors. Still, there is always the possibility of seeing years of stagnation. The main problem with thinking that it's safe to withdraw the entirety of your yearly gains, other than the fact that market returns vary hugely each year, is that it leaves out the consideration of inflation. $1 million will be eroded in value over time due to inflation. Since the average return of the S&P 500 is 10% per year, consider that the first year in retirement you'll average $100,000 in income. That's a pretty decent amount for the first year. Fast forward 30 years and that $1 million has lost the majority of its value. Even though it's technically still worth $1 million and still generates an average of $100,000 per year in gains, that doesn't have nearly as much buying power as it did before. Assuming an average inflation rate of 3%, in just 24 years the power of that money would be cut in half. There are varying opinions on how much is safe to withdraw from your investments every year. In theory, you could withdraw the gains, but that method isn't sustainable for the various reasons mentioned. Some people recommend only withdrawing 3% a year due to market uncertainty. Others suggest that 5% is safe since there hasn't been an extended bear market in a long time. As a rule of thumb, 4% should be considered a safe withdrawal rate. Don't confuse this with the portfolio's overall returns, as this is strictly the withdrawal rate. This means you can withdraw 4% of your portfolio during your first year of retirement with adjustments for inflation each year after. During the first year, you would withdraw $40,000. If the cost of living rises 3% that year, you could withdraw $41,200 the following year and so on for the next 30 years with a near 0% chance of running out of money. The 4% rule is based on multiple factors. Firstly, it's calculated for someone whose portfolio consists of 50% stocks and 50% bonds, which is quite conservative. Dave Ramsey, one of the most conservative investors, recommends that people keep 100% of their money in growth stock funds with zero bond allocation. He claims that bonds are arguably as risky as stocks and with much lower returns. Everyone has different preferences for the composition of their portfolio, but it's recommended to have more exposure to bonds and less exposure to stocks as you age. The higher your stock allocation, the higher your average returns and risk will be. Secondly, this 4% withdrawal rate is based on a 30-year retirement, meaning if you plan on retiring in your 30s or 40s, 4% might be too much and the funds could very well dry up in the future. If you plan on retiring for 30 years, this method would mean you'd have almost 100% chance of never running out of money. The problem with planning for a 30-year withdrawal period is no one knows how long they're going to live. If you knew the exact day you'd kick the bucket, it'd be easy to budget each dollar and know exactly how much you could spend. There are some people who say that they want to enjoy their money, so they plan on spending it all. Or that you can't take it with you when you go, so you might as well enjoy it while you're still alive. That's a great philosophy, but the problem is you don't know how long you're going to live, and that's why you need to be careful with how much you spend. The Social Security Administration estimates that the average remaining life expectancy of a 65-year-old is less than 30 years. However, That's just an average, and investors should plan for a long retirement. You don't want to cut it too close and end up going broke. The risk of running out of money is an important one to manage. You should consider your health and genetics to get an idea of how long you'll think you'll live. If you're already retired or over the age of 65, your planning horizon might be different than a general 30 years. The average life expectancy has risen about 5% over the previous 30 years, so it's important to keep that in mind. 4% might be too much to withdraw if you plan on being retired for more than 30 years. Social Security benefit amounts vary depending on your retirement age, how long you contributed to the program, and what your taxable income was over the years. If someone begins taking benefits at age 62, they will receive much less money per month than someone who retires at age 65, 67, or 70. The average Social Security benefit per person is about $18,000 per year. If you add that to your 4% withdrawal from your portfolio, that's $58,000 per year in income. Of course, if you're married, the Social Security benefit would be double that, bringing your total annual income to $76,000. That's a livable amount for many retirees, considering the average household income in the United States in 2020 was $68,000. Taxes will vary significantly for different people. How much you'll owe primarily depends on what type of retirement account you use. Most common is a traditional IRA or 401k, which will require distributions to be taxed at ordinary income rates. With a Roth IRA, the taxes have been paid at the time that the contributions are made, so distributions will be received entirely tax-free. However, many people have a variety of accounts, including a brokerage account, 401k, IRA, and a Roth IRA, making the taxes hard to closely calculate. In addition, it will depend on whether or not you live in a state that has an income tax, your filing status, and obviously your income bracket. Take into consideration what type of accounts you have and your projected tax bracket to predict your tax liability, and consult a CPA to assist. Generally speaking, a $1 million portfolio composed of 50% stocks and 50% bonds will produce $40,000 per year in income. The safe withdrawal rate changes based on the composition of a portfolio, expected years of retirement, and a variety of other factors. When you consider the average Social Security benefit of $18,000 per year, this brings your total annual income to $58,000 for an individual or $76,000 for a couple before tax. Use this as a starting point and make adjustments for the many variables different people will have. Remember that it's not sustainable to withdraw the entire gains of a portfolio, as inflation will surely reduce the underlying value of $1 million. It's a good idea to be conservative when projecting your finances during retirement due to uncertainties.